Very good morning to you, and welcome to the TriggerCharts pre-market rundown for Friday, June 10th, 2022. I'm Andrew Horowitz, and the markets are pissed off. The inflation number came out today, 8.6% year-over-year inflation rate, and it's in a time. In fact, if you read down into the numbers and into the information, that it turns out that the food and energy was an issue, but food more than energy. In fact, food prices came back a little bit, which is pretty interesting. So right now what we have is a situation where not only are we seeing a substantial amount of inflation overall, but on top of it, what we're seeing is a substantial amount of, unfortunately, concerning inflation in areas that hit people that, well, really can't afford it. So there's different kinds of inflation. All of them are bad. But this inflation that we see right now is a problem. So we knew this going in, but it was pretty hot at 8.6%. Anyway, right now what we're going to talk about is a few things. We have a important disclosure we need to talk about. Investing, of course, involves substantial risk. Past performance is not a guarantee of future results. And everything we talk about today and each time that we get together should be considered for educational purposes only. That's what we're talking about, education. And we're going to talk about some of that. But really, the themes that we're going to talk about are also very important, right? So please, you can also participate by putting your particular symbols here, right there, right there. Okay, let me clear up this board a little bit. And let's get down to closing this. We saw this pretty well. And let's talk about what's happening, the themes in the market. Well, we have bear market action. I thought we'd discuss that a little bit because I had a discussion with that on another podcast. And a lot of people, when they think about the idea of a bear market, they consider, it has to be 20%. That's right. A bear market is 20% down from a previous high. Well, that is one definition that we can look at. The fact is, when we think about bear markets, though, when it comes to the market structure, when it comes to the essence of what the market is doing, these are the kind of things that we see, that bad news is bad news, good news is maybe good news, possibly not. And the fact is that we see a lot of instead of the buy the dips, we see the sell the rips. And what's happening right now is we're seeing very much so that happening. Each time that the S&P 500, for example, got into we'll just say close to the 4150 range, thereabouts, there was some major overhead resistance and it sold off. Now, whether it was because of this news or this information or that, or whether it was really because of none of that mattered, it was all about the fact of where we had that overhead resistance, doesn't matter. Fact is, we are in a bear market situation. That does not mean that you can't own stocks for the long haul. That doesn't mean that you can't trade. What that does mean is you need to be ready for much wider moves on a daily basis. You need to be ready and understand the fact that what you have is a situation that markets are going to be much more volatile. That's why we see the VIX so escalated, right? And you're going to see the fact that there is more of a lean into the sell side, if you will, than the buy side. In other words, there's going to be people that are going to be looking to unload rather than buy more of substantial value. I will share with you that in one of the portfolios that we manage for clients, there is a substantial amount of cash in there. And what we're trying to do is slowly deploy on very, very important rules. But secondly, any of the discretionary that we're doing requires us to have very small positioning. We're not taking big risks. The other theme is clearly inflation. We talked about the 8.6% year over year. We see that May was a rough month on a month-over-month basis, 1% up from April. Wow, that's pretty intense. That's inflation. And if you're under the age of 40, you may not have seen this ever before. You don't know what to do and you're freaking out. Well, what's happening right now is the chart to the right. We've left this up for a while now for a reason. This is inflation. This is what it looks like. Now, whether you want to blame it on the war, whether you want to blame it on China, whether you want to blame it on Russia, whether you want to blame it on Iran, you want to blame it on Biden and the Keystone this, or the fact that we're not allowing fracking there, I don't care. But daily crude prices, up, and away, right? That's what we're seeing right now. And what's happening is it's even today, in a day that we're seeing significant declines in markets where the NASDAQ is down 196 on the futures. We got 384 after yesterday's 600-point dump on the Dow, and the SPOOs, or the S&P, down 1.3% right now at 53. Gold is also down slightly, and Bitcoin, of course, taking a little bit of a hit on the noggin when we have a risk-off day. That's how it's playing right now. But we did see the initial run-up of crude, this parabolic move that we saw right here, right? This blow-off top, roll back down with reality hitting. China saying, hey, you know what? Maybe we're going to be locking down. We saw that back and forth inside of here. Well, right now, there is really no end in sight because we're getting to a point of, we're getting very toppy right here. And you're getting above the level. That is a big concern right here. That can rotate this up a little bit higher right now because there is no resistance. Let's face it. There is no resistance right now when it comes to EARL, as we call it here. Economics, the ISM services. Well, we saw strong hotels, airlines, restaurants. We saw the service sector do pretty well, and that is inflationary. We're seeing that hotel prices and airline prices and restaurant prices are like, huh? I mean, you try to book a hotel, you try to book an airline, the prices are ridiculous. Absolutely ridiculous. ISM manufacturing, well, that's holding up pretty well. We had to do a replenish of the inventories that were knocked down so significantly. Remember the fact that we saw that inventory levels were really low, and we saw the follow through with Walmart, Target, and other companies that over-inventoried. They overbought. They bled down inventories. So what's happening right now is a situation where I think we are seeing a couple of interesting things play out, clearly, where we have the ISM manufacturing holding up, employment initial claims low, still in the 200,000s. We saw the hiring is starting to come for like a Walmart. Some places are talking about firings or letting go or, letting people move on, whatever you want to call it. Fact of the matter is that right now where we are is a situation where we have a generally strong economy. The Fed is trying to break it by putting their leather boot on the neck of the economy to slow it down. That's what's happening. I mean, there's no question about that, right? We're seeing that happen very significantly. So when we look at this and we see what's going on here, what we notice is that there is a significant amount of overall concern in the markets, and that's playing through in this bear market structure. Right? We saw these pre-announcements, Target and Walmart. They are deflationary announcements that they put out. But the question you have to ask yourself is, how long is it going to take for that to really make its way into the economy? And if, in fact, we are seeing higher prices that are in food, but yet we're seeing lower prices in energy and possibly in retail, it may give itself a little bit of room to, let's call it, stabilize rather than drop. I think there's some deflationary forces that are happening in the market. You're starting to see that in a lot of different areas. You're starting to see it clearly in risk assets, no question about that. Some areas of the real estate, you're starting to see that. And you're starting to see it in areas of the bonds where, if we skip over for a second, let's see where this is playing right now. We're seeing, look, the bonds are right now, the 10-year is actually down a little bit from where it was, ticking zero from where it was yesterday. With the idea that we have an inflationary environment, now we're starting to see some things that are playing out, right? What are we seeing? We're seeing that there is a significant amount of drop in the markets, yet we're seeing that the yields are ticking higher, but we have this resistance point, 3.04, 3.05, right there. Right there is where we are. That's the resistance point that we're seeing. Now we get above there, we break above there. You have a little bit of room on the top, maybe a 3.0, 3.1. Possibly. But what's happening right now is that there is some people that are saying, you know what? Hey, bond prices are going to be a problem in certain areas of the bond world. And the big issue right now is we're seeing a significant move on the dollar and a significant move on rates. And we're seeing that the ECB is talking about raising rates, but yet China is cutting rates. And Japan is saying, hell no, we're going to stay with what we have. We like what we have right now. We like the fact that we are basically funneling everything we can into the idea of dropping the yen down and causing a decline in the value of the yen. That's good because we're a net exporter. We're a net exporter. And as a net exporter, what they're doing is that they are doing whatever they can to try to essentially make it a bargain for you to buy their products. So we have a lot of forces that are going on back and forth with China dropping. Now, all of a sudden, the Eurozone is saying, hey, you know what? We think we're going to be starting to consider, due to the fact that we have runaway and rampant inflation, you know what? Maybe we need to raise rates eventually. And the Fed doing the same thing. So we have this concerted effort right now, but yet there is a bit of a muting of bonds. I think some of that, because you would think you'd see it a little bit higher right now, some of that is the fear factor, and people are rotating out of stocks and saying, you know what, we're going to buy some high quality. And this is the Treasury, of course. You know, this is supposed to be the safest thing out there. It's supposed to be. So the USD is on fire, right? Let's take a look at that. $DXY. And look at where we are. I mean, we see this big move today, right? Up and starting to come back down a little bit, with the idea that now the Fed fund futures are pricing in about a 62% chance, or 58%. I forgot. I just looked at it. 58% maybe. Well, somewhere between a 58 and a 62% chance of a third 50 basis point rate hike in September. Already they're pricing in for the next two meetings, and they're looking at the potential for, so it's June, July. And now they're looking for the potential for maybe August, September, sometime in there, of another 50 basis points. That's what's going on right here with the DXY also. Although, once again, now that we're starting to see other countries say, hey, you know what? Maybe we're going to think about doing something, in the area of potentially raising rates to combat this. Some countries, and some countries are dropping. I mean, Russia just dropped again. They dropped 150 basis points today. 9.5% to the level it was pre-war, which is remarkable. And I think that, what we're seeing is this very exacerbated move. Now, the moves today are going to be exacerbated early. They'll calm down a little bit, I think. It may stay right here. It may get worse. It may get better. But I'm saying that I think that we had a lot of players that are one side or the other of the dollar trade, the bond trade, the yield trade, and the market trade before this number came out. So now what we have is a squaring up. All those are long going in saying, hey, inflation's over, no problem, no big deal. We're going to go back to lower prices very, very quickly because of all and they would bet long on it. Well, they're unwinding their positions early. And the people who were saying, oh my God, we're going to have a ridiculous number, are probably unwinding a few positions there and putting on a few positions otherwise. So what's happening this morning is a little bit of that push and pull in regard to that. The Euro USD, I mean, just abysmal. Euro keeps on dropping, or better said, the dollar keeps on coming up. I mean, we're talking about what are we at? Well, 1.05. Yep, 1.05. And this is from a long run. Look at this. I mean, we're at a low point. You want to go visit Europe or Japan? It is a really good time to do that. I was going to bring that up. Yep. USD, JPY. I mean, look at this. It's down a little bit. The dollar today, just a little bit, but just looks like this 136. Clearly, a lot of green going on here. Really never since February. Since February. One little move to the downside right here, right? This range right here. You look at this range right about here. Otherwise, it was really held support, rose higher. And now again, this is a concerted effort by the Japanese government, the Bank of Japan, if you will, to do their best to keep interest rates significantly low. And, the yen's going to follow along with that. What else do we got here? Eurozone, new commentary, risky business. There's a few things happening right now. I want to show you something. Down a little bit more today, a little bit of break. Look at that. Whew. That was yesterday. Today is still falling down. This is the IEV. This is the iShares Europe ETF. Now, part of this has to, if you think about it, has to do with the fact that the euro has been coming down in value pretty significantly. Pretty ugly chart. And you look at this one too. Not much better. It just looks pretty much the same. There's a lot of Europe in there. There's the IFA. So you got, both of these are actually giving us a very good sign that the dollar is very strong. That's the fact. Now that's going to start hurting, and that has continued to hurt things like silver and gold, right? The dollar up and Bitcoin for that matter. Gold can't get anywhere. Now we got a short call on gold. It's looking like it finally fell down. It tried its best to hold up a little bit, down just a little bit today. Silver just nowhere. Got a nice pickup after this big drawdown that we saw from mid-April through May. And now in June, got a bit of a pickup now, holding on to support. A little bit low, 6 cents down. No big deal today at 19.90. So gold and silver is just not doing anything. But what's happening is, I think one of the things we need to look at is the risky business of being in banks in Europe. That's a concern of mine. And when we look at the fact that probably better to be in banks here in the United States, generally speaking, there is a concern that Credit Suisse and a few others are just not equipped for this kind of situation right now. And without the Eurozone and Lagarde raising rates, it's obviously not very healthy for the banks. And that's a problem because net interest margins, which really are predicated on higher rates and raising rates over time, the low rates are really a killer for banks. And the inability for them to really make money on net interest margin is going to preclude them from sending money out and from providing for loans. And that's a problem for the economy. On top of the fact that their loans will sour going into a really bad economic downturn, especially because they're so reliant on this. Now, we have a small position of, for example, European stocks in portfolios for clients. It's a long-term diversification methodology that has done very well over time. But the fact is that right now is one of those times that you got to hold your nose for a little while and just deal with it. Maybe even buy more of it eventually when things start turning around. Big question right now is, what is your game plan? We talked about this whole idea, right, of a bear market action. We talked about inflation. We talked about what is going on with currencies and with markets like we're seeing them right now. Do you have a game plan? And that's something that you need to really reinforce with yourselves right now. Somebody's asking me about XLE. Would I buy XLE? XLE. Let's take a look. XLE is down today a little bit. Some of the stocks inside of there are just going to be affected, like Exxon and Chevron and Occidental Petroleum. Pretty ugly today, but generally speaking, been on a nice tear. But let's get back to XLE for a second. Let's take a look at the signals on this, right? So some time ago, we talked about this area that it had a break above. It did so very nicely. I always leave these, these annotations on here. It did break above that. Right now, we're still seeing that there is supportive action on this. So on the daily basis, you'd have to say that, you know what? You're starting to see a little bit of a breakdown here. Support's about, 89.5 or so? Where do we go from here? Well, 87.07 is possibly the next downside level that you may see here. Generally speaking, though, when I look at this, the general trend on a momentum indicator, the aileron, is still very positive. And then on top of that, what you have is a situation where, you're seeing, upside. And the upside looks pretty good right now. Problem is that you have a market that is going down 460 points on the YMs right now, down 227 on the Qs, down 1.64% on the S&P 500. The problem is that 80% of a stock's action is often attributable to what's happening in the underlying markets. And the underlying markets are not doing well. So when you look at what's happening right now, there's a lot of things that, may be doing better than others. But the problem is that right now we're seeing, there you go, there's the break. There's your break on your bonds. There's the break on the bonds above. Well, we still have some time to break above, but you did break above this line, that 30.50 that I talked about earlier. Put this line in right here, right there. 34. That's a problem area, and that's why you're seeing further deterioration in the indices right now. There's a knee-jerk reaction that's happening right now. So to answer the question about XLE, I would take positioning if you think there's going to be an opportunity for long-term gains in the sector due to the fact that oil prices have been so high and are going to maintain those levels for some time to come. And the fact of the matter is that many of these companies have years of profitability that's still ahead of them. If you look back on XLE, and maybe we'll do that for a second. I think that would be an interesting exercise. look back. Let's go down and let's take but let's look at this on, let's go monthly. Did I do that? Did I click it? Monthly? There we go. You're still not back to the all-time high that we had back in 2014. Right now, you're somewhere around here, this level, right? Which is that peak that we saw back in 08. So interesting. What we have right here is just, you're almost there. Any updates on the new subscription of KRI? Subscription? Yeah, so back to, yeah, I understand what you're saying. So the question is about the subscription process on these products. So we are working now with somebody. We have still a few more months, a month, a couple months. Anyway, whatever the time period is, a couple months to work out the details with TradeStation. And everything is fine right now if you keep the subscriptions that you have right now. There is a potential for, in the works, a new way of subscribing to the products. And you'll do that actually outside of TradeStation and right into your, outside of the TradeStation trading app store, but right into your TradeStation. You click a couple buttons and we'll just install it for you. All right. I had to take a little drink right there. Let's get back. KRI's in equilibrium is a point, though. We did see that rollover right here. And right now, where are we trading, right? We're trading at 395. So down here. Wonder if we're going to hit those lows again. That's a big question. Let's look at some stocks here. Bitcoin. Bitcoin. Let's not do monthly. Is interesting. Look at that, right on that monthly level. Let's go back to daily because I like to look at the dailies. Bitcoin has been holding on pretty well on this level. Right now, we're on just below the 30,000 level. But look at this line that we drew there, 29,700. Currently trading at 29,500. That is a really strong level of support for whatever reason. That may break if we do see markets fly out and go crazy right now. But bottom line is that we are seeing a significant amount of support at that level. Generac, I mentioned this on a DH Unplugged podcast right about here. Probably about 226. Picked it up for clients. We're at 229, 299. See if it can hold up this level here. Breaks down below some of these levels, like probably about 260s. We may take some profits in that. Nice return. Basically, what they are is a generator company, and now we are in a time of hurricane season in the U.S. Kind of stop looking at the war and all this, but we are in hurricane season, and people usually buy hurricane supplies during that period of time. SIG, interesting, down substantially today, but up big the last couple of days. Big move up from the downside. We like this as it broke above. There was really not much up here, but right now, where's it trading at? 65. Oh, 65. Not too terrible. 65 and change right now. Taking a little bit back, right on the support level. Pretty good right there when you can connect a few lines right there, right? There we go. If we drew that in, 65, 66, currently trading right about that in the pre-market. Big move, a lot of short interest there. CRISPR, another big move recently. This is a biotech company with the area of CRISPR, even though the name is CRISPR. It does CRISPR, which is gene editing, essentially. And what you have here is break above just momentarily. Right now trading a bit below that, right? Trading at 68 and change, so trading a little bit below that right now, but there is support there. Interesting move right now. Edit is this redheaded stepsister of CRISPR. Really not there. Just not there. Amazon trading down at 119 here. Yes, it had a split, by the way, a 20-for-1 split. And what we're seeing right now is this big move down, a hopeful drive higher off the bottom, off double bottom here. We had nice support. Right now trading what? Down $2, which is the equivalent of $50 or $60 actually. It's almost $3, $60 on the downside. Right now on the fact that, look at this, we're starting to see some further degradation and bleeding in the area of the Qs and the YMs. Interesting. Novavax. This is just amazing. This company, it has a vaccine. Just I think it was 20 to 0 and one abstain on the vote for the CDC to authorize usage of it. And what's fascinating about this is that this stock just cannot get any legs. There's some bad news associated with it. May or may not be used. It's for COVID, but just not doing well. K-Web, I told you to watch this some time ago. We looked at these levels. It dropped below. It has to break above there, that 38 and change. Long way to go for that, of course, from 32. But we are seeing a double, triple bottom hold on the levels. We're seeing that a nice move to the upside on the aileron here. Generally speaking, this is the Chinese internet stocks. What happened was that companies like Didi, I think we have these on here, here's one, Baidu, really kicked up pretty hard when the government said, well, maybe we'll let you do something there. Didi, that doesn't look like a lot, but Didi moved up 50% in one day, right? They were at about 150, and they're all the way about 3. That's about 50% in a day, right? Is it more than that? About 80% a day, but finished back down. Fact is that the ride-hailing company, which was excluded from the App Store in China, or in their version of the App Store, is coming back potentially. Then you have the NIO, which is the Chinese Tesla, theoretically, that's what people call it. Dropped down pretty hard yesterday after a big downgrade. You can see that doji with the hammer on the downside there, right? That's what you see right here. Not a good sign right there. But big moves from the bottom, a lot of big moves from the bottom. Question is, are we going to get back there again? I mean, right now, it's looking pretty ugly, the markets right now. Let's take a look at where bonds are, back to where we were on that. Yeah, look at it, still going. Almost 3.1. So, big problems in bond land. That's why you got to stay short on your bonds right now. Short term is best. Where was I? Oh, yeah. And the horrible news of the day is... right here is DocuSign, because DocuSign is trading so far below our charts, we'd have to expand our charts a little bit. Trading right about here. DocuSign is trading right about here. On its support, 67, 66 and change, 65. Bottom line is that they had some questionable numbers. Actually, I thought their report was okay. It was, I think, a report that's reflected. Let's go back to where I was. Reflected. Reflected in this drop right here from 228, and then the successive moves lower here. I don't know if it really deserves to be this low right now. I'm taking a shot at trying to pick up a little bit of this in the after hours last night. So far, so wrong. Very small amount. But yet, I think I may add to it a little bit. There is some support down low. And probably if we do this, yeah. Let's move this line to, what did I say, 60. There is some support down there in the 60, 690 level. Interesting, definitely problematic. We saw the reversion of back coming up here on the monthly. That this is a lot, a weekly. There's a lot of really big problems right now, but we are seeing there is support down this level. Kind of where it's trading, give or take a couple of cents right now in a very bad market condition as well. Remember that. You can't deny that. Fact is that what we're seeing right now is a flush out. This could be an interesting point. They still have good revenues. They did drop their expectations ever so slightly. Their revenues came in higher than expected. They also came in with a lower expectation or lower EPS than was expected. That was a big problem. That's really what was the shake. And the outlook was a little bit downtrodden from where they were. I still think it's a very sticky app. And from a fundamental standpoint and from a futuristic standpoint, an interesting thing to look at. Anyway, thank you so much for being here. We'll be again next Friday, of course. And we will make sure that we do our best to help you out, understanding all the things that are involved in the market and TriggerCharts indicators themselves, as well as all the things that we do with regard to our levels and support and resistance. Thanks so much for joining me. I'll see you again next week. Bye-bye.